I just want you to read one paper. It's not a long paper, as I said. It's only 6-7 pages that explain the relationship between oil prices, financial liquidity, and geopolitical risks. So this paper is cited here. We wrote this paper in 2017. It's co-author paper with Professor Mahmoud Al-Gamal from Rice University in the United States. So as I said, what we're trying to do here, we're trying to link these three variables together and see how they are, how they move together. So why did we do this research? We looked at the oil prices and what happened in the past, and recent drops in oil prices motivated our work. So what happened? So oil prices fell from a peak of $115 per barrel in June 2014 to under $35 at the end of February 2016. But this wasn't the first drop, so it happened before. It's very similar to what happened in the 1980s when OPEC members reversed their area production cuts, and this is a supply-driven drop. Also, it happened in 2008-2009 at the outset of the global financial crisis as a response to the collapse in demand. So what happened in 2014, the drop in oil prices happened before. So oil prices went through several episodes of ups and downs. So what makes it different this time? That's the question. Some people even start calling it a new normal and invite policymakers and governments, especially in oil exporting countries, to start dealing with this as a new normal. This is a new fact. This is a different sort of drop. So it's not very similar to what happened before. So many people explain this by what happened in shale production in the US. So the US started to expand their production from shale oil, and that led to the OPEC cartel to lose its market supply power. So OPEC doesn't have the same power as it used to have before on oil prices. Also, forecasted oil demand, so this is supply factor. The demand factor, the forecasted oil demand continues to decline. I guess now you hear more about electric vehicles, for example. You hear about why, well, many countries, they start investing heavily in renewable energy. Okay, so the future demand for oil is not as it was, so it's declining. Again, this is due to technological advances and environmental regulations as well. So that's why people start thinking this time is different. It's not like before. As we said, in terms of the drop of oil prices, it happened before many times. It went through ups and downs. It's fine. But this time people believe it's different, and that's why they start calling a new normal. And we want, or they invite policymakers, and especially in oil exporting countries, to adapt to the new normal. Okay, new normal here meaning the low level of oil prices, relatively low compared to how it was. So the question, what if oil prices remain low? Okay, how this is going to affect the world economy. So basically, if you think about two groups of countries which have much oil, they are oil exporting countries, and countries which are importing, so they are oil importing countries. So basically, you would imagine that it's normal to expect that there will be significant revenue shortfalls in oil exporting countries. So they're going to lose much of these revenues because of the low oil prices. On the other side, consumers in many oil importing countries are likely to pay less because now it's cheaper, okay, or it should be compared to what it was. So here's a problem with countries, oil exporting countries. They depend on oil revenues for a long time, okay? But what is happening today, especially in the Middle East and North Africa region, MENA region? So oil exporting countries are expected to lose these revenues, or to have a sharp drop in their revenues due to the new normal or the low oil prices. So it's not just a temporary shock, it might continue to be the case. So if we look at these countries, MENA countries, again, Middle East, North Africa, oil exporters, so their economy have low degree of diversification, meaning that much of their economies depend on oil. Okay, so some of these are 60-65% depending on oil. Gulf countries did something. They tried to accumulate these revenues in what they call sovereign wealth fund. So they tried to keep aside some of the money when, in good time, they had high prices and oil prices were high, and that enabled them to keep some money aside. So what we expect, or what is expected, that, and this is actually what happened recently over the last few years, to maintain the same living standard in these countries. I don't know if you know that or not. These countries, you don't pay tax. You don't pay income tax. Okay, it's not like here. When you have a job, you will see how much you pay. It's like 1/3 of my income just goes for tax here. Okay, so when you live in the Gulf countries, in the past, there's no tax. Okay, many things are free. It's free money. It's high prices for oil. The oil exporting countries, they get so much money from this. So that explains to you how much these countries were dependent on oil. Okay. So to maintain this sort of living standard, these countries try to withdraw from the sovereign wealth funds, from the money they kept aside when the price of oil was high. Okay, but this is a temporary action. This is something could work in the short term, mid-term, but how long it's not sustainable. So you're not going to be just withdrawing. At some point, these will dry up, so it's no money anymore. Okay, and the idea of these sovereign wealth funds were actually some sort of keeping this money for the generations to come. But now you have to use them now because of low oil prices. But anyway, if you look at other countries like Iran, their economies are slightly more diversified, but with limited sovereign wealth funds. So they don't have this massive books that we're gonna withdraw money from. But anyway, so let's just now think about what policymakers in oil exporting countries in general and in the MENA region in particular are forced to do. Late, painful, and unavoidable transition. Meaning, after, as I said, having a long period of time relying on large revenue windfalls from oil, now they need to adapt to the new normal. Also, the effect of low oil prices, it doesn't affect only oil exporting countries in the MENA region, but it also affects other countries, neighboring countries like Egypt. Egypt is not an oil exporting country, but Egypt relies on remittances. So migrants to Gulf countries, they work there, they send money back to Egypt. Also, we rely on investments coming from the Gulf, from other oil exporting countries. So again, this new normal might affect both oil exporting and their neighbors as well. But how do we look at this new normal, it could be a threat, it could be an opportunity, because I attended one of the conferences about this topic last year, and the vice president of the World Bank, in his speech, he gave a talk in that conference, and he quoted a report about 30 years ago, decades ago, about how important that this country need to transform their economies away from being so much dependent on oil. So what I'm trying to highlight here, that this is a fact that was known a while ago, years ago, but now you have no option. So policymakers at that point, they had the luxury of choosing not to do this transformation. Why? Because they had revenues, that there's no problem, okay? But now, whether you like it or not, you have to do it, okay? And that is the point. So that's why I'm saying it is an opportunity, yes, because we couldn't do it before, we didn't do it before, but now you really need to start taking it more seriously. And I think that is what many countries in this region start doing. So it seems that they accepted now the new normal, and they try to have some sort of medium to long-term economic plans to diversify their economies, and these are known as 2030 visions. I visited Saudi Arabia last year. Wherever you go there, you have these massive banners, massive signs about 2030 vision. Okay, so something that has so much political support in the country, so something is taken very seriously at this point. So what are these about? So as I said, this is not just in Saudi Arabia, by the way, it's in Egypt as well. We have our 2030 plan. So what are these visions? What they're trying to do? So the prominent feature of these visions, that they rely on massive infrastructure investment or mega investment programs. So they spend so much money on massive investments, and they're hoping by doing so they will transform the economy away from oil dependence and provide jobs to their labor force. So that means they need massive capital needs here. If oil prices remain low, where are they going to get this money from? So Saudi Arabia, the privatization, including an initial public offering for Saudi Aramco, the oil company, and this was the largest in history. And also foreign direct investment. So they rely on that they can make the country more attractive to investors, so they come and invest in that country, and then they try to, again, to reduce its dependence on oil. So the success of these visions, or what they have in the MENA countries in this region, is important not just for MENA, for the entire world. Why? Because what's happened in the MENA or in the Middle East doesn't stay in the Middle East. I guess you all understand that. So it somehow affects other parts in the world as well, especially Europe. So it's very important to understand how successful, or what are the chances that these visions or this sort of transformation plans will succeed. As I said, what's happening in the Middle East affect other parts in the world, especially Europe as well, in terms of how close they are to the Middle East. So what happened recently? We had the uprising in Tunisia, Egypt. You have civil wars, proxy wars in Libya, Syria, Iraq, Yemen. Different powers in the world, they fight in Syria. Russia, the US, more regional powers like Turkey involved in Syria, Turkish troops in Syria a long time ago. Saudi Arabia in fighting Yemen. You will never hear this in the news, but actually there's war there, fighting in Yemen. So you have Egypt Egypt troops were found in Libya. So it's just crazy in this part of the world. So it came to a point you don't know who's fighting who. So you don't know really who's fighting who. So it's just happening that way. So it's a very difficult situation at the moment. But anyway, so this is what was called the Arab Spring, which I think it turned to be winter or fall. Just name it whatever you like. So that is the idea here. So we try to look at these three variables. Okay, we try to look at oil prices and to connect this with geopolitical risks and global liquidity. These series here, so this is data from 1990 to, I think, to 2017. 1980 to 2017, if I remember. And what we see in this figure is just these variables, three variables, they move together. So we're trying to say there are some cycles. We're trying to explain what is happening in the Middle East, what's happening in terms of geopolitical risk, what's happening to oil prices, what's happening to global liquidity. So we saw these cycles in the history. So we try to sell you the idea that this is something that is not new. It happened before. So the beginning of the petrodollar age, when the oil prices increased in 1973 and 1979, there was simultaneous occurrence of high liquidity dollar-based regime, and also there were some geopolitical catalysts: Vietnam War, Arab-Israeli War, Iranian Revolution. So there was some sort of geopolitical tension and risk at that point as well. Okay, so again, when this petrodollars were recycled from oil exporting countries because they have limited absorptive capacities, this would increase financial liquidity. So they've got so much money, they don't have the capacity to invest that money in the domestic economy, then they need to inject that money back into the global economy. That will increase liquidity, that will increase financial liquidity. If we move to the mid-1980s, again, low oil prices, start with first Iraq War, the rise of terrorism at this point, and I'm here quoting Osama bin Laden, when he called this is the greatest theft in history, when he commented on the decline of oil prices to $9. Okay, so again, I'm trying to show you there are links between geopolitical risks, geopolitical tensions, war, etc., and oil prices and liquidity. So these are the three variables we're looking at. So the phenomenal increase in oil prices starting 2003, again, feeding global liquidity. So the oil prices increased in 2003. That fed global liquidity, so have more financial liquidity, and also the second Iraq War, when the US invaded Iraq. That was 2003. And this also contributed to financial crisis, and my co-author, Professor Mahmoud Al-Gamal, has a book in this. He wrote a book on this. Okay, so you can read that book if you like to. So you probably, I'll add it on Blackboard. But anyway, if you look at the Arab Spring in economies that were cited as in reports by international institutions like the IMF and the World Bank, that they are exemplary economic success, and that was the case in 2005 and 2010. And then 2011, the uprising happened. People are not happy. Okay, so what went wrong? So where's the problem? And as I said, I don't know if I said that before or not, the economy in Egypt grew by around 5 or 6% a year on an annual basis. It's a massive growth rate. Okay, and then till 2010. So in economic terms, if you look at only growth, then you remember when we talk about economic development, yeah? So it's not, growth is not bad, but it's not enough. That's what we said, if you remember. I said this in the lecture about 20 times. Okay, growth is not bad itself, but it is not enough. And that's exactly what happened in Egypt. We had a fantastic growth rate. 5 to 6%. That's amazing growth rate. Okay, it's a very high growth rate. But in 2011, people just on the streets. Okay, so again, we try to understand this in a more global context where we look at these three variables. What is happening? Why oil prices important to MENA countries? Of course, we have most of these rich oil countries in the Gulf, so it's in the area. So there's some connection. That's what we're trying to establish here. So when you look at the literature, what empirical work showed, so there are links between oil supply shocks and economic activities and financial markets. How does that work? So there's some sort of causality. So it calls to oil supply shocks to economic activities, like output, investment, etc. There's a reverse link from economic activities to financial condition. And there's also potential relationship between oil prices and geopolitical risk. And that's exactly what we tried to do. We tried to bring all this together in one piece of research. We tried to link these three variables: geopolitical risks, oil prices, and financial liquidity. We try to see how these variables interact together, and more importantly, to understand what is happening. That's what we want to know. What is happening? And then what is likely to happen in the near future? Okay? So I don't want to bother you by the econometrics or the statistics, what we actually did in the paper, but just a brief summary of the data set, what we used. We used data for 70 countries from 1979 quarter one, so it's quarterly data, till 2017 quarter two. We collect data about some global variables and country-specific variables. We had data about liquidity, global financial liquidity, oil prices, and we use this geopolitical risk index that was cited in my first lecture, if you want to go back to it and see how it was composed. And then we also added GDP, gross domestic product, total investment, international reserves, and hopefully we understand now the importance of international reserves, and geopolitical risks and bilateral trade. So countries are connected to each other through trade. So don't worry about the econometrics again. So we built the model, some sort of statistical or econometric model. We estimated that model, we replicate that model like we estimated 2,000 times. Just try to see what's happening. So what we were interested in, we were interested in seeing what happened if there's a shock to oil prices or to any of the global variables, oil prices, financial liquidity, and geopolitical risk, and how other variables will respond to that shock. Again, what we're trying to do here, we're trying to understand what happened and what will happen. And we see the effect of these shocks on other variables in this system or in this model. So, as I said, I'm not going to bother you with econometrics. You don't have to worry about the methodology section in that paper. I mean, still you can read it, by the way, because it's written in a very, very simple way. So we're not going to have so much complication. So please read it if you can, because it's not very difficult. And as I said, it's a very short paper. It's written as a letter, so it's not written as a full paper. The full paper is about 50, 60 pages, and it's also available online if you want to read the full paper. But again, if you want to just know what it's in that paper, just read the letter, the small paper, which is 6 pages long. So what did we find? That's the summary of the results you see. We find if there's a negative oil shock, and that's exactly what we saw, drop in oil prices. So when I mean oil shock, means shock to oil prices. So oil prices dropped. How this affected geopolitical tensions, risk, or the wars, or the probability of having a war. And by the way, geopolitical risk here, it doesn't have to be war. It could be the threat of war. It could be any tension. And that's what the geopolitical index, the geopolitical risk index capture. Okay? So if there is a negative shock to oil prices, we expect that geopolitical risk will increase. And liquidity, financial liquidity, will drop. Well, it's very straightforward to understand this link. If oil prices drop, then obviously this will be translated into drop in financial liquidity. Okay? And at the same time, and that's what we added to the literature, that also geopolitical risk will increase. So geopolitical risk, geopolitical tension, the possibility of having a war, it will increase. Okay, and that's what we see now. And as I said, this paper was written in 2017. Today, I think some of the findings in this paper, we see it happening now. One is the rising geopolitical risk or tension. So if there is a positive shock, meaning to geopolitical risk, meaning that there's an increase in geopolitical tension or risks, how this is going to affect oil prices? Oil prices will increase slightly, and this is exactly what's happened over the last few weeks. Okay, so oil prices now is going up. So if you see any chart of oil price, you see the massive drop in it was going up after 2003, then from 2014 just sharp drop down, and then now is going out slightly. And that's exactly what we said in that paper a few months ago. Okay, so if there's a positive shock to geopolitical risk, then liquidity will drop, oil prices will increase slightly. That's what we have. So the third point is, what if there's a negative liquidity shock? So what if liquidity drop? Well, we found that geopolitical risk will increase, oil prices will drop. So in addition to this, and I'm going to conclude with this, so I'm going to finish in a few minutes. In addition with this, we were interested in two scenarios. We try to, if you did modeling before, if you did econometrics before, you know, some econometrics is about trying to forecast, trying to expect something will happen. And then also you build some scenarios. Okay, so what we did here, we said, what if there were a negative shock to liquidity? So global financial liquidity dropped, and there was positive shock to geopolitical risk. There's more chances of war or conflicts and tension, etc. Why? This just to explain why. The reverse petrodollar recycling to finance Saudi deficits. Obviously, Saudi Arabia has deficit now because of the low oil prices and monetary tightening and elsewhere. Also, ongoing wars in Yemen, Iraq, so that make us believe that there are chances of geopolitical risk to increase as well. So there must be, there could be a positive check to geopolitical risk given the situation there. Okay, these two work in opposite direction, as we explained here. So remember, if there's a positive shock to geopolitical risk and a negative shock to liquidity, so these work in opposite direction for oil. So the geopolitical risk lead to increase in oil prices, negative liquidity shock lead to drop in oil prices. So they work in opposite direction. And that's why we were interested to know what would happen if these two shocks happen together. So we had a drop in financial liquidity and increase in geopolitical risk. And also the other scenario we were interested in was what if there's a negative shock to financial liquidity and oil prices? And that's what we have today, or what we had before, because when the oil prices dropped, so this negatively impacted financial liquidity. Okay, the reason we had rise in financial liquidity because there's some petrodollars that were recycled in the global economy, because these small countries, especially Gulf countries or exporting countries, they were not having their economies didn't have the capacity to invest all this money, so they have to invest it somewhere else, and that will increase financial liquidity. So what we're looking at here, we're looking at a negative shock to financial liquidity and oil prices at the same time. So again, what we found that these combined effects is mildly negative on oil prices. And also what we warned is that the warning was the response will continue to be manifested in heightened geopolitical risk. So this is something we said a few months ago, and I think we continue to see it now. So it is still there. So final remarks, just to conclude this, what we should expect. We should expect continuation of low oil prices, declining financial liquidity, and medium-level heightening of geopolitical risk. Significant oil prices drop triggers surge in geopolitical risk, and again, that means increase the chances of geopolitical tension, war, etc. And this may lead to higher oil prices in a later period, and this is what we see today. Okay, again, this was written a few months ago in 2015. Now we see what we discussed in that paper. We see it happening. Also, major financial liquidity shock due to significant monetary tightening is unlikely to have a significant effect on geopolitical risk and oil prices. Why? Because we find in this paper that financial liquidity is serving as an accelerator for oil prices movement. So it actually increases the effect on oil prices, but it doesn't initiate that effect. Okay, so just support it, make it more or greater. So, and that's it. So one thing I want you to read, one more thing I want you to read. So the paper, and also we had a policy article. We called it "When Stuck in Quicksand, Stop Kicking." So please read that one. So if you click on that button, you read. It's an article, so it's not a paper. So it's about maybe 1,000 words or less. Okay, and it's the idea here is we're trying to say to policymakers in the Middle East and North Africa, especially in oil exporting countries, in this age, in this time of new normal of low oil prices, transformation, let me put it in a different way. The best way to transform the economy is not through mega projects. Okay, it's just very similar to when you get stuck in quicksand. If you keep kicking, you're actually sinking more. To go out of quicksand, you have to move very slowly. And that's exactly what we're saying in this article. So our policy advice to policymakers in these countries, that it is painful, but it has to be slow. And it has to be managed in a different way, not through massive spending on mega projects. This is the bottom line in this article. So please read this article, and if you have any comments, you can comment on that page, or you can send me your comments. Okay, so that's it. So this is exactly what we wanted to cover in this lecture. Again, or what we try to do, we try to see the links between oil prices, financial liquidity, and geopolitical risk, and we try to use this to understand what happened and what is happening now and what might happen in the future. Okay, and again, it's important for the exam, not just to understand. Okay, obviously, I hope you're gonna read this topic because you want to understand what's happening, you want to understand what's happening around you, but also there'll be a reward in the exam. Okay, so please read this topic carefully. And as I said, you're not asked to do much really. Of course, you are welcome to extend your reading beyond what I'm saying. But what I'm saying now, this is the basic reading. So this is what everyone has to read if you want to answer this question, and also for you to understand what's happening. So there are two things to read now. The paper, which is cited here, by the way. So this is the paper. And the article, "When Stuck in Quicksand, Stop Kicking." Okay, any questions? Okay, so as I said in the beginning, well, we'll have seminars today. These are the questions we discuss in the seminar. Explain different types of financial crisis, so hopefully you're all now aware of these different types, and then we'll discuss the transmission, how these or why these financial crises, when they occurred, they spread so quickly to the rest of the world. And also we'll have some reflection on what we discussed today, the relationship between oil prices, global financial liquidity, and geopolitical risk. And remember, the exam questions are very similar to seminar questions. That's why it's important to turn up to the seminars. It's important to engage with the questions in the seminar sheets. Okay? Okay, next lecture. I'm not going to teach you anything new. It's a revision lecture. We'll talk about the exam structure. If you want to do seminar, I'm happy to go through the past paper. If you want to do just one lecture without the seminars, and we do both, do the revision and the past paper in just one lecture, I'm open to your suggestions next time. whoever will turn up. Okay, so anyway, thank you for coming today, and I have office hours today and tomorrow. If you have any question, please come and have a chat with me. If not, as I said, all your questions, I'm happy to answer your questions about the exam next lecture. Okay, thank you so much.